In modern finance, there is a quiet sentence hiding inside the fine print of every bank statement. Your deposit is not a sealed box with your name on it. It is a liability on the bank's balance sheet. In plain language, it is an IOU. Most days, that distinction feels academic. Your card works, your transfers clear, your paycheck arrives on time, and the system rewards you for trusting it. But when a banking system buckles, that single legal distinction becomes the difference between my money and my claim. Entrust. Over the last decade and a half, 3 countries delivered the same lesson in 3 different ways. Cyprus, in March 2013, showed the world a blueprint. Deposits above the insurance threshold were converted into bank equity as part of a resolution package, with roughly 47.5% of uninsured deposits at Bank of Cyprus converted. Greece in the summer of 2015 proved you can lose access to money without an explicit haircut. Banks closed, transfers were restricted, and daily cash withdrawals were capped at €60 for a period, turning savings into a number you could see but not truly use. Lebanon, beginning in late 2019, demonstrated something even darker. Informal freezes, shifting withdrawal limits, and a multi-year trap where balances remained visible while real access collapsed. By 2025, that crisis is still widely described as unresolved, with depositors effectively locked into a broken promise. These are not morality tales about small countries alone. They are stress tests of a universal system built on confidence and maturity mismatch. Banks fund long-term assets with short-term deposits. When confidence holds, the machine hums. When confidence breaks, speed becomes the weapon. In an era of one-tap transfers and social media panic, a bank run no longer needs lines outside a branch. It needs a rumor and a login screen. Now here is the uncomfortable part for an American audience in 2025. The United States has spent the post-2008 crisis era building resolution frameworks designed to avoid taxpayer-funded bailouts by imposing losses on shareholders and creditors when a large institution fails under special resolution authority. And while FDIC deposit insurance is a powerful backstop for insured amounts, the insurance fund is not a magical vault equal to all deposits. It is a fund designed to be replenished and supported through the system's tools. And it sits alongside a banking sector that still carries meaningful interest rate and credit risks. So this story is not the banks are evil, or the end is guaranteed. It is more precise than that. When a crisis hits, governments protect the system first, and the legal definition of your deposit determines whether you are protected, limited, converted, or delayed. Once you understand that, you stop asking, "Can this happen?" and start asking, "What would it look like here? And who pays first?" Actuals. To understand why depositors keep ending up on the wrong side of crises, you have to rewind to 2008. When the global financial system cracked, governments chose speed over fairness. Banks were rescued with public money. Central banks printed trillions, and losses that should have destroyed private balance sheets were transferred onto society. The logic was brutal but simple. Let the banks fail and the entire system collapses. Save them, and deal with the anger later. The anger, of course, did not fade. Taxpayers watched executives keep bonuses while foreclosures spread and wages stagnated. Too big to fail became a political toxin. So regulators promised a fix. Never again would taxpayers bail out reckless banks. Never again would public money be the first line of defense. On paper, this sounded like reform. In practice, it changed only one thing: who absorbs the losses. This is where bail-ins were born. Under the new framework adopted across the United States and Europe in the early 2010s, failing banks would be resolved internally. Shareholders would be wiped out first. Bondholders would take losses next. And if that still was not enough to cover the hole, large depositors would be treated as unsecured creditors. Not customers. Not savers. Creditors. Legally, this shift matters more than almost anything else in modern banking. A bailout socializes losses through taxes and inflation. A bail-in privatizes them inside the institution. Your deposit is reclassified in a crisis not as money held for you, but as funding the bank is allowed to restructure. Converted to equity, frozen, limited, or delayed indefinitely. Cyprus was not an accident. It was a controlled experiment. European authorities wanted to send a signal: banks can fail without taxpayer rescues. What they also signaled, perhaps unintentionally, was that deposits above insurance limits are risk capital in disguise. Greece refined the approach without an explicit haircut. By trapping money through capital controls, the government avoided a visible confiscation while achieving the same functional result. Lebanon removed even the pretense of formal process, relying on exhaustion, legal paralysis, and time. Each case followed the same political logic. Once a banking system is too large for the state to rescue, officials face an impossible choice: print enormous amounts of money and risk currency collapse, or impose losses inside the system and preserve nominal stability. Every modern government has chosen the second option when forced. The uncomfortable truth is that this framework is not a conspiracy. It is written policy. It exists because banking systems are leveraged by design, and because democratic governments cannot repeatedly ask voters to underwrite private failure. Bail-ins are the compromise. They keep the system alive by sacrificing the claims of those who trusted it the most. And this is why the question is no longer whether bail-ins are fair. The question is timing. When the next shock hits, when losses are too large to hide, and when confidence evaporates faster than regulators can respond, the legal machinery is already in place. Depositors are no longer outside the blast radius. They are part of the containment strategy. Once you strip away the headlines and the local details, banking crises stop looking random. They follow a pattern so consistent that it reads less like history and more like engineering failure. Cyprus, Greece, and Lebanon did not collapse for the same political reasons, but they collapsed through the same financial mechanics. And that matters, because systems fail according to structure, not intention. The first stage is always scale. When a banking sector grows to several times the size of the real economy, it becomes mathematically impossible for the state to rescue it in full. Cyprus's banks held assets roughly 8 times national GDP. Lebanon's were about 4 times. Greece's system, at its peak, dwarfed the productive base of the country. Once banks reach that size, the promise of safety becomes conditional. There is no backstop large enough. The second stage is hidden risk. Banks load up on assets that appear safe until they are not. Government bonds, long-duration securities, real estate loans based on inflated valuations. These positions generate steady profits in calm periods and massive losses when conditions change. Crucially, accounting rules allow many of these losses to remain invisible until liquidity is demanded. The balance sheet looks fine until depositors ask for their money back. That leads to the third stage, the trigger. It is never the same event, but it always exposes reality. A sovereign debt restructuring, a political standoff, a currency shortage. The moment losses become undeniable, confidence cracks. And confidence is the only thing holding a fractional reserve system together. Stage 4 is speed. Depositors act rationally and withdraw funds. In the digital era, this phase is compressed into hours or days. What once took weeks now happens over a weekend. Banks do not fail because they are insolvent, in theory. They fail because they cannot meet withdrawals in practice. Stage 5 is intervention. Governments step in to stop total collapse, but by this point, options are gone. Bailouts are politically toxic or fiscally impossible. Printing money risks inflation or currency panic. So authorities reach for tools that preserve the system by redistributing losses internally. Bail-ins, capital controls, withdrawal limits, freezes. The final stage is long-term damage. Even when banks reopen, trust does not. Savings behavior changes. Cash hoarding rises, investment falls, credit dries up. Economies stagnate not because the crisis happened, but because belief in the system never fully returns. This pattern is not historical coincidence. It is the logical outcome of leverage banking combined with political limits. And once you recognize it, the question shifts again. You stop asking why Cyprus or Lebanon failed. You start asking which systems today meet the same conditions, and how far along the pattern they already are. At first glance, the United States looks nothing like Cyprus, Greece, or Lebanon. It issues the world's reserve currency. Its banks are large, diversified, and tightly regulated. Its government can borrow in its own currency, and its central bank can create liquidity at will. These differences feel decisive. But when you map the structure instead of the symbols, the similarities become harder to ignore. Start with scale. The American banking system is not 8 times GDP, but concentration matters more than totals. A handful of institutions hold a massive share of assets, deposits, and payment flows. When size and interconnectedness combine, failure stops being a private event and becomes a systemic one. Regulators understand this, which is why orderly liquidation authority exists at all. It is an admission that normal bankruptcy cannot handle modern bank failures. Next comes hidden risk. After years of near-zero interest rates, banks loaded up on long-duration bonds and securities that appeared safe. When rates rose sharply, the market value of those assets fell. Under accounting rules, many of these losses remain unrealized as long as banks do not sell. On paper, capital looks adequate. In reality, it is conditional on depositors staying calm. Then there is commercial real estate. Office buildings financed at pre-pandemic valuations now face refinancing at much lower prices. These loans sit on bank balance sheets across the country. Losses here are slow-moving, but they compound quietly. They do not need to cause an immediate crash to weaken confidence. The trigger, when it comes, does not have to be dramatic. It could be a recession, a wave of defaults, a geopolitical shock that pushes capital abroad, or simply one high-profile bank failure that reminds depositors how fragile confidence really is. Once withdrawals accelerate, the math takes over. This is where digital speed changes everything. In the past, regulators could close banks, calm markets, and reopen branches before panic spread. Today, withdrawals happen through apps and APIs. Liquidity leaves before press conferences begin. Silicon Valley Bank showed how fast this can unfold. That was not an anomaly, it was a preview. At that point, intervention becomes unavoidable. And intervention, by design, prioritizes continuity over individual claims. Deposit insurance helps, but it has limits. Above those limits, deposits are treated as unsecured funding. The legal framework does not guarantee loss. It allows it if needed. This is the uncomfortable truth. The United States does not need to look like Lebanon to behave like Lebanon at the margin of crisis. Systems fail at their weakest points, not at their averages. And the tools meant to prevent chaos work by redistributing pain in ways that are legal, structured, and devastatingly quiet. When people imagine a banking crisis, they picture chaos. Crowds, sirens, politicians scrambling on live television. In reality, the most consequential moments happen quietly, over a weekend, inside legal documents and emergency meetings. By the time the public understands what is happening, the outcomes are already locked in. A modern crisis begins with liquidity stress, not insolvency headlines. One institution announces losses, delays a report, or seeks emergency funding. Depositors notice. Large accounts move first because they are managed professionally and monitored daily. Money does not disappear, it concentrates elsewhere. That concentration accelerates the problem. The weaker the bank becomes, the faster deposits leave. Once regulators step in, the goal is not to save the institution. It is to preserve the system. Payments must clear. Payrolls must run. ATMs must function. To achieve that, authorities separate what is essential from what is expendable. Equity is wiped out. Bonds are written down. And deposits are sorted by legal category. This sorting is where expectations collide with law. Insured deposits are protected because they are politically untouchable. They are the social contract. Uninsured deposits are different. They are large, concentrated, and legally unsecured. In a resolution, they become tools. They can be converted to equity to recapitalize a new bank. They can be frozen to stop runs. They can be limited to buy time. None of this requires malice. It requires arithmetic. If losses exceed capital and bond buffers, the remaining pool is deposits. Authorities do not ask whether this is fair. They ask whether the system survives. Capital controls, if imposed, follow the same logic. They are framed as temporary, technical measures. Withdrawal limits, transfer approvals, restrictions on cross-border movement. Each one sounds reasonable in isolation. Together, they transform savings into a conditional promise. You still own the money. But ownership without access is an abstraction. What makes this phase so dangerous is duration. Controls rarely last days. They last months or years. As time passes, inflation erodes value. Emergency rules become normalized. Legal challenges stall. Depositors adapt by lowering expectations. The loss is not a single moment. It is a slow bleed. This is why past crises feel misunderstood. People remember the headline event and forget the aftermath. The real damage happens after the cameras leave, when trust is gone and behavior changes permanently. Understanding this is not about panic. It is about realism. In a crisis, your outcome is determined less by what you believe and more by where you sit in the legal hierarchy. And most depositors do not realize where they sit until it matters. After the emergency phase ends, governments declare stability restored, banks reopen, markets calm, headlines move on. From the outside, it looks like recovery. From the inside, something fundamental has changed, and it rarely changes back. When depositors lose access to savings, even temporarily, their relationship with the financial system breaks. Money stops being a neutral tool and becomes a risk to manage. People behave differently. They hold more cash. They split accounts across institutions. They avoid long-term commitments. Businesses delay investment. Credit demand shrinks, not because opportunities disappear, but because confidence does. This behavioral shift is the hidden cost of banking crises. Economies do not stall only because capital is destroyed. They stall because trust, once broken, is expensive to rebuild. Greece offers the clearest example. Even years after capital controls were lifted, deposits never returned to pre-crisis levels. The system technically functioned, but belief did not. Banks feel this change immediately. With fewer stable deposits, they lend less. With weaker lending, growth slows. Governments respond with stimulus, subsidies, and guarantees, which increase public debt and reinforce the cycle. The system survives, but it does not heal. It adapts to lower expectations. Inflation compounds the damage. Emergency measures often involve monetary expansion. Even when deposits are not explicitly seized, their purchasing power erodes. For households, this feels like a betrayal without a signature. No account balance changes, yet living standards fall. The loss is diffuse enough to avoid protest, but real enough to be permanent. Legal resolution adds another layer. Bail-ins, conversions, and freezes generate years of litigation. Most cases go nowhere. Courts cannot restore money that no longer exists. Governments argue necessity. Banks argue legality. Depositors learn a harsh lesson about priorities in a systemic crisis. This is why recovery narratives are misleading. Systems stabilize faster than people do. Markets rebound before households rebuild. And once savers internalize that access is conditional, they never fully return to pre-crisis behavior. The long-term outcome is a quieter economy, a more cautious public, and a financial system that functions but commands less loyalty. It is not collapse. It is erosion. And erosion, over time, reshapes everything. The final lesson of Cyprus, Greece, and Lebanon is not that catastrophe is inevitable. It is that banking is a legal structure before it is a service. When stress arrives, contracts speak louder than assurances, and survival of the system outweighs protection of individuals. Deposits feel like property, but in law they are claims, and claims are renegotiated in crises. For most people, the danger is not losing everything overnight. It is assuming safety is binary, insured or not, stable or unstable. History shows something more subtle. Access can be restricted without confiscation. Value can be destroyed without a visible haircut. Time itself can be used as the instrument of loss. This is why concentration matters. Keeping large balances in a single institution creates a single point of failure. Diversification is not paranoia. It is basic risk management. The same logic applies to form. Assets that exist only as ledger entries inside one system are vulnerable to that system's rules. None of this requires predicting dates or panicking about headlines. It requires understanding hierarchy. In a crisis, governments protect payments, then institutions, then politics. Depositors above the insurance line come later. That ordering is not a theory. It is written into resolution frameworks and demonstrated repeatedly. The United States has not repeated Cyprus or Lebanon, but it does not need to. It has its own tools, its own language, and its own legal pathways to the same outcome. Capital controls need not be called that. Bail-ins need not be announced with that word. They can appear as temporary limits, emergency conversions, or orderly resolutions. The effect is what matters. History does not repeat because people forget. It repeats because systems are built the same way, under different names. The pattern is already written. The only variable is whether you recognize it before you are forced to live inside it. If this analysis helped you see banking differently, stay with this channel. These stories are not about fear. They are about clarity. And clarity, in uncertain times, is the most valuable asset you can have.